My name is Garth and I'm a technical analyst and an ETF strategist with Traders Corner. On this episode, we're going to take a look at the S&P 500 and the bear market rally that we're currently seeing in the market right now. And we're also going to take a look at an ETF that one could potentially trade if one believes that this is a bear market rally that ultimately follows up with another leg to the downside. The first chart that I've got today is a daily chart of the S&P 500, and there's a couple of things I'd like to talk about on this chart. Notice that we saw the big move up. We've now rallied 20% up off the recent lows on this market. So a very powerful bear market rally. Also of interest is the fact that we've now seen a death cross occur. That's where your 50-day moving average starts to cross down below the 200-day moving average. Now, there's a lot of skepticism around this and whether one should actually rely on this as a trading indicator. I personally don't see it as a buy or sell indicator. I just see it as an indication of the momentum in the market. When your 50-day moving average is down below your 200-day moving average, that generally is an indication of a weak market environment, and that's often an environment where you'll be wanting to short the rallies, i.e. a bear market environment, and that appears to be what we're going into now. Another thing to note is that the relative strength index at the top of this chart is below 50. And as a rough rule of thumb, I always feel that if the RSI is below 50, that is an indication of a weak market and a downtrending market. The other thing to note here is the volume. I find this very interesting. You'll notice that during the recent decline in the market, it happened on rising volume. So heavy selling pressure, lots of volume came into the market as the market collapsed over the last couple of weeks. What you'll notice now is that on this rally that we've seen over the last couple of days, that volume has actually been dropping off quite sharply. Now, that is not a healthy sign. That is an indication that this is a bear market rally and that ultimately the participation on the upside is not that great. And it probably does end up leading to another leg to the downside on the S&P 500. The next chart brings in the Fibonacci retracements. So we've got the 50% Fibonacci retracement, which comes in at around about 2,800, and then a 61.8% retracement, which comes in just above 2,900. Keep an eye on that area. If the market rallies up into that area and then reverses down, that would potentially be the area to look to start getting short for another leg down in this bear market. My next chart takes a look at an ETF that one could potentially look to trade to play this. It's the ProShares Short S&P 500 ETF. The share code here is SH. What this is, it's an inverse ETF, no leverage, so it's a 1x leveraged ETF, and it trades completely inverse to the S&P 500. So i.e., if you think that the S&P 500 is going to make another leg to the downside, then you'll want to be buying this ETF. The question is where to buy it and how to avoid getting in too early. Now, the final chart that I've got here takes a look at an hourly chart of this ETF, of this ProShares Short S&P 500 ETF. The reason I bring up an hourly chart here is because I want to focus specifically on the 15-period exponential moving average on that hourly chart. That's the blue moving average that you can see on this chart over here. I think what's important is to see this ETF begin to trade up above that 15-period exponential moving average. If you get that, then that will be your buy signal. In other words, go long of this inverse ETF because that'll probably then signal that the S&P 500 is about to take another leg to the downside. Take a look at what happened in early March. You'll see a little falling wedge pattern there and notice that the market, that this ETF broke up above the 15-period exponential moving average. And that was then your buy signal to actually get long. And if you had done that, you would have capitalized really nicely on the market falling with this inverse ETF then rising in value. So that's what I'm going to be looking for in the week or maybe the weeks ahead. Keep an eye on this, wait for the price to cross up above that 15 exponential moving average, and then only look to go long of this ETF. Don't just try and blindly pick a bottom, because what you can find is that these bear market rallies sometimes can go higher than you expect. So be careful of getting in too soon and then getting squeezed out. What you want is to see that the momentum is actually turning and then get involved. So wait for the price to break above that exponential moving average on the hourly chart and then get long. That's all I've got time for this week. Please join me again next week where I'll do some more market analysis and a look at some other ETFs.